Hello friends, hope you are doing well. So there are so many factors going on in the world which is affecting Indian stock market. Either you can take US Fed rate or you can take growing inflation, even rising oil prices, even Russia-Ukraine crisis. So all these having an impact in Indian stock market. However, what is the impact in the banking sector? So today we are going to talk about the banking sector in length, what is the outlook, how it is going to perform in future, and what are the stock recommended. So guys, stay till end. My name is C. Tapandoshi. I welcome you in my YouTube channel. So let us start. And if you're not subscribed to the channel, just subscribe the below button and also click the bell icon so you'll get all the new notification of my videos. So let us start. So as you can see here, Indian banks, there are a lot many concerns going on in Indian banks. The first one is that there is an impact of the recent spike in crude on the economy. So as you are aware that due to this geopolitical crisis, the uh, crude oil was above $130 per barrel. Now it is come down to, actually today it has come down below 100 also. So that's a good sign. But however, it is having a big implication on Indian stock market because inflation is bound to rise, and as India is the second largest importer, okay, of crude, so it will have a big impact in inflation and in our growth also. So that's a concern. Again, the second point, not seen aggressive loan growth recently, that can cause high stress. Okay, so now loan growth, even though the interest rate was on the lower side, that it's not good. Okay, the reason is that as the economy slows down, people are not taking more loans and they are not doing expansion plan, like companies are not planning any expansion plan. That's why the loan growth in recent times, even the interest rate was low, it is not seen. Okay, so that is also a concern for the bank. Now another thing is slow pickup in credit demand. As I told, because of the lockdown and everything, there was very low credit growth. Okay, people were not borrowing loan because they are not seeing any expansion in their business. That's why they were not borrowing loan. Even the corporate were not borrowing loan. That's why there was a slower pickup in the credit demand. Fourth is borrower weighs the benefit of putting fresh capex because a weak consumption cycle could limit demand. As I told that companies normally they don't put a large capex expansion plan because no, if they don't see any in near term a future uptick, they will not borrow the money. So that is a problem. See, even though low interest rate is there, but it never aid in economy because at the end of the day there should be a demand in the economy, and lower inflation always bring a less demand in the economy, correct? So that's why everyone strives for the higher demand. And if in a way higher inflation helps the economy, because at the end of the day what will happen if there is a higher inflation, that means there is a demand uptick, and that's why people are borrowing more money and they are deploying in their company. But the inflation should not be higher because of oil rise. Okay, then that's a different factor completely. So that's why as when the interest rate was low, even the interest inflation were also low at that time. I'm not talking about now, but few months ago. So but fresh capex were not planned by the companies. Okay, now, fifth point is earlier as nominal interest rate declined, there is a strong signal that the economic cycle is weakening, as has already weakened. Okay, so as you can see, earlier as nominal interest declined, signal that economic cycle is weakening. See, when interest rate will decline when there is no demand in the market. Okay, or what there is a less demand in the market. At that time only, bank in our RBI will reduce the interest rate. Okay, so that demand comes up, and also RBI will reduce interest only when there is a inflation is under control. So all are in sync. Okay, so now the sixth point is change in inflation within the cycle will impact the cost of capex and not necessarily the loan growth. So basically, if the inflation goes up, okay, and it should impact it will impact the cost of capex. Okay, net not necessarily the loan growth. So if the interest rate goes up also, the impact will be on more on the capex side, not on the retail demand. The reason is simple, that retail demand will pick up only when overall economy is going up. Okay, first the companies will borrow the loan and they will increase their capex cycle, and once they start increasing capex cycle, the income will flow to the lower segment. Okay, so at the end of the day, corporate plays a big role in this. That's why even there is a change in inflation, even there is a rise in interest rate, which is going to happen in coming monetary policies. The first impact will be on the capex and not on the loan growth. Okay, so so these are various concerns, and of course, as I told you earlier, also, no, the oil is a big factor, even though it has gone below $100. Now there is no surety that it may not spike again. Okay, so that's why RBI will take everything in consideration. Also today, the US Fed rate policy announcement is that they may increase rate by almost 0.25 basis. That is an expectation. So let's see how that over a global bankers, whenever they increase the rates, how Indian RBI bank will increase the rate in future. So RBI is currently behind the curve, and it is monitoring. Currently, there is no alarming situation in India that we should increase our interest rate, as inflation is not so big. It is around 6.1% something around, but not high as it is in US, because in US and all that is almost, you can say, 40 years high. So that's a different ball game complete together. So let's see. But this is the reason why there is a no loan growth, which I have given concerns about. However, there are many silver lining also. First, let us see about what is the implication of this. Well, because of this, that not very optimistic about expansion of NIM. NIM is nothing but net interest margin in an increasing rate environment. So what is net interest margin? Basically, you pay interest on the deposit, and whatever money you get, you pay. You basically give a loan to the customer. So, and again you charge interest rate through customer. So whatever difference is the net interest margin, excluding expenses. Okay, this is a plain vanilla formula I talked about. Now this, it is actually analysts are thinking that expansion of NIM will not be there even because of the increasing rate or environment. Okay, so that is a negative for the banks. Asset quality is not in. Now this is the biggest positive which the banks are having currently in last, you can say, from last 5 to 6 years, that currently asset quality is not an issue, and NIM has actually expanded in a subdued loan environment post COVID. Okay, so when there was subdued loan growth, okay, during the COVID period, very few people had taken at that time. NIM expansion was there. Again, the biggest plus point, as I told you, that asset quality has improved a lot from last few years, and most of the banks, their worst scenario of NPS is behind them. Okay, so now this is the biggest positive, because that whatever NPA comes on will directly eat away the profit, net profit. That's why asset quality is not an issue. That's the biggest positive. So during this time, that basically, as I told in the third point, lender focus on growth, which implies the spreads are likely to decline and not expand. Okay, so lender always tries to that it should increase the growth, because the growth was on a lower side, as you are aware, that from due to COVID situation. Now they want to focus on much more on the growth side. Okay, they want to increase their loan growth. Okay, so that means they will not focus on NIM too much. That's why it will not expand. So basically, this is the reason. One of the implication may be that NIM may not increase, is that loan growth focus will be there. And fourth, when lenders even loan, they are likely to go off control NIM to some extent. Now it may possible that they may NIM may reduce a lot. Even not even you can say that they will maintain, but they may reduce the NIM if they want to give a push to the growth. Okay, so that is the reason NIM will be under focus. So this was the implication. Now let us see what is the way forward for banks. Well, the way forward is the loan growth is driven by first the confidence on economic condition, and second is ability to pass through higher commodity costs. See, First is economic condition should improve, which is improving now. But the problem is higher commodity costs. Whether the companies are able to pass through these commodity costs or not, that is the main problem. Okay. The commodity costs are on a higher side because of the geopolitical crisis. All metals, everything is on a higher side. So if company feels that okay, they are able to pass on, means they are able to increase the price of their goods, then only they will go for the borrowing of loan. Otherwise they will ignore it. Okay, so this is the thing, loan growth can come only if they are able to pass higher commodity costs. Now that's why currently after COVID there is no aggressive loan growth post COVID. Also high liquidity, low interest, rising inflation, yet weak loan growth. Now, even though there is a high liquidity, low interest rate, even rising inflation, there is a weak loan growth because they still, corporates are not able to forecast that whether they will able to pass on these higher commodity prices to their customer or not. That's why expansion plan is little bit on a back seat. Loan growth is lot more depend on a stronger outlook of economic growth. Fifth is corporate should be comfortable with leverage levels and confident that return ratios on fresh projects are well justified. As I told you, corporate should be very much comfortable with the leverage levels, and they should be confident that whether the return ratios will be there or not, because whether they are able to pass on these commodity increase prices to their end customer. And if they pass, of course, there is a rise in inflation. Retail consumers are likely to take credit when they are a lot more confident of the income. So it's like a vicious cycle. Okay, if corporate is not expanding or like now, then if income of the salaried person not increase, then they may not take more credit because they will try to save because that if the situation is tough. Correct. So that is a thing. Getting strong positive feedback on the asset quality cycle for the overall banking sector. Now, this is the only positive point. As I told earlier, there is a strong positive feedback on the asset quality cycle for the overall banking system, and which will remain. So, this is the major point where this is why there is a re-rating happening for the many of the private banks. Banking loan portfolio is tested through demonetization, GST, ILFS crisis, and even COVID, which impact the rest of the retail and MSME portfolio. So from last few years, you can say 5 to 6 years, all these events happened, and basically Indian banking sector is able to sustain all that. Now that NPA cycle is behind us, that's why if you say if you talk about current scenario, yes, you can go for the banks, and banks are having a good visibility. So at the end, my recommendation is that currently COVID all this NPA cycle is behind us. Credit cycle may give an uptick in coming months. Okay, once this all this geopolitical crisis fizzle up, and also metal prices go down and everything, and also there is a strong demand in the economy, then of course, even though interest rate will go up, there will be a uptick in the economic cycle. And if there is an uptick in economic cycle, bank will do well because now NPAs are less, and that will add on to their margin for. So based on this scenario, my recommendation for the banks are that SBI, just a minute, I recommend SBI, the target is around 485, ICICI Bank 975, Axis Bank 960, and DCB Bank 145. So all these banks are good. Even HDFC Bank and Kotak banks look good, but HDFC Bank may not be in the same bull run which it used to be earlier, because it has his own issues which he has to come up. But overall, then also it is a very good stock to invest. But however, I prefer compared to HDFC Bank, SBI, ICICI Bank, Axis Bank, and DCA Bank, even you can say Kotak Bank for that matter. So guys, this was all about banking sector. It looks good, and hope you like this video. And if you like this video, please like the video below, and subscribe to my channel, and you will get lot of fundamental analysis through this channel. And also for regarding this, I have launched a course thoughtful investor model course where I'm going to talk about all the fundamentals of various sectors. And if you want to attend a free webinar, now you can just click below link and we can meet you in webinar. I can make you understand all the fundamental analysis and how to value a stock and everything. So guys, me Sieto Pandoshi signing off. Thank you. Stay in touch.